Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. The S&P had its worst week since April, and it was about the same story for the NASDAQ. Gold hit record highs but didn't have the steam to go higher. InsideTrackTrading.com President Eric Hadik gives us his insight into the cycles surrounding the stock markets, gold, the U.S. dollar, cryptocurrencies, and crude. So far, his targets have been bang on. Author of the second edition of the book When the Bubble Bursts, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, checks in from Edmonton. Toronto has seen prices fall with a glut of tiny condos on the market, but new home builders are still holding on to their set prices. Hilliard also takes a look at the EV market from the perspective of being a longtime Tesla owner. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclicode.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show.
Good to be with you, Jim.
Ross, how would you describe what happened on the stock markets this week?
Well, I mean, it's been a long time coming, but the overbought conditions that we've been looking at and the various technical measurements that we look at all came into place this week. So here we've got the S&P worst week since April, and the NASDAQ, the same type of thing. On the other side of the coin, a week ago, small caps came to life. They went just extremely overbought in the first couple of days of their run, and now they're pulling back. But, here we are. The big channel that we've been looking at, it's almost a century long. It starts from the 1929 high in the S&P, a couple of really good spots on the channel. We hit the top of that in October of 2021. And you expect to see then a pullback and a retest of that channel in the window what we were into here this year. The target for the resistance was to be 5,400 to 5,600. And I think that all depends how thick the lead is in your pencil in terms of accuracy of the trend line. But bottom line is 5,600 was a really good upside target for the S&P, regardless of the fact that it's, capitalization weighted rather than sort of an equal weight. The fact is that it did manage to get up to some pretty important levels on the charts that we look at. And at the top end of it, in the last 10 days, we got upside exhaustion readings on the NASDAQ, and the S&P in both the daily and weekly charts. We also got sequential nines, so it's 9 consecutive bars with closes above 4 bars earlier. Those combinations, we hadn't seen those in the better part of a year. So to get as overbought as we were seeing, all you needed was a little sign of reversal, and we did get that. Now, the cycles also that we're looking at, we're due to top out. There's the 17-year cycle, which is something that I know a number of people are watching. The specifics on that one, the high has come into place here as you would normally expect in July, and historically the month of July is one of the second best months of the year. Compared to, I guess, second only to what happens coming out of the October-November bottoms. But the fact is that July tends to peak by mid to late month, and a few of the examples go out into August. But usually by the time you get to mid-July, you're running out of time, so you look for any signs of reversals for the market to stage a correction. So here we are, getting something that really was in the cards. It was just a question of when was it going to happen.
Ross, what's going on with gold?
Really interesting week here, putting it mildly. We hit all-time highs, got up to $2,500, and that was, in theory, a breakout. And it had been preceded around the 10th or 11th of the month with a sequential 9. Also, we saw the same thing in silver. So both markets were a little overdone getting into the breakout. But what's important, when we look back, the previous 3 breakouts from 2019 through 2024 ended up not giving back anything. Once they hit that sequential 9 and became looked overbought, they did not pull back beyond the breakout level. They continued to push along really steadily. And if you look at a short-term moving average like an 8-day or a 10-day, they did not come back and violate those for well over a month or two. So it was really important that this breakout managed to have some steam behind it. And guess what? It didn't. By the time we got to Thursday, it was starting to see a reversal, and overnight on Thursday night, clearly we were starting to see a failure, and was ended up down at $2,400, down $100 off the highs. So the dailies clearly have run out of some momentum here. The important thing is that on a monthly basis, we had sequential 9s there as well. These are very infrequent. I think we've got maybe 10 of them since 1985. And the most common thing here would be to pull back to the 20-month moving average. That takes us down below $2,100. So $300 below where we are right now is where you would expect to see some underlying support. And at this point, the miners, which have been doing reasonably well on the upside, are probably going to see the same type of correction, a pretty hard one in the next month or two.
What's going on with crude?
Well, crude oil had a poor end of the week after being up at $83 early in the week, but closed under $79. So we're past the seasonal run on the upside, probably going to continue to see some downside pressure in here. We do have an upside reversal in terms of the U.S. dollar the last few days. That's also, that's another thing that's been putting a damper on any of the commodities that are priced in U.S. dollars. So that includes the oil market together with the precious metals. So things sort of following, in step with one another.
Anything happening with the Canadian dollar?
Really quiet. We're at 72.82 at the end of the week. The resistance is up at 73.5. No doubt that next week there's an anticipated rate cut by the Bank of Canada. That bringing the spread once again between Canada and the U.S. under pressure. So, the Canadian dollar, even though there's some very large short positions at this point, unless we get through 73.5, the easiest direction is to the downside.
Ross, thank you so much for the update.
Pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on X at Charts by Ross. Coming up, Eric Hadik, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Thanks for having me back, Jim. Pleasure to be here.
Eric, before we get rolling into the interview, can you tell us a bit about Inside Track Trading?
Inside Track Trading is an advisory service that is primarily technical and cyclical based on the financial markets, commodity markets. We provide a subscription-based newsletter and alert service with a couple different variations geared towards short to intermediate traders, and longer-term traders.
Eric, you sometimes discuss cycle analogs. What are cycle analogs, and do you have any examples?
Yeah, they are actually an interesting phenomenon in the market. They're a little more on the rare or not so common situation. And they are when you see and when you anticipate an analogous period in a particular market, something that parallels and perhaps mimics the action of of a past period of time. And there are a couple different reasons why I will look for them to occur. Some of it has to do with where within a wave structure a particular market is. Some of it has to do with particular cycles and when they often are more close in sync with each other as opposed to the phases of a wave or the phases of a cycle where you get a more extreme movement in the markets. But let me just give an example to kind of bring that down to something tangible. Ever since late 2022, I have been talking about the gold market and my expectations that a new bull market starting in late 2022, and that was the latest phase of a very consistent 7-year cycle that had timed previous lows in late 2015, late 2008, late 2001. And it was also the convergence of several monthly cycles and a very synergistic combination of cycles that were telling me to look for a new multi-year bull market. But there were also some reasons to expect some very close parallels to the previous bull market that we had seen from 2016 into 2020 in gold. And sure enough, gold started to move rather similarly to how it did at the beginning of the previous bull market. For example, in 2016, gold and silver started out their bull market with a 7 to 8 month rally, and then they sold off for the subsequent 5 months. Well, in 2022, 2023, gold and silver rallied for 7 to 8 months, then they sold off for about 5 months. So they were starting to parallel that action of 7 years earlier, and it was starting to add more credibility to this analogous period that I was looking for. And as always, I should kind of give a little caveat here. I'm never discussing or looking at things like this unless there is a pretty convincing synergy of many corroborating cycles or corroborating indicators. So it was not just this one cycle analog, but it was a myriad of reinforcing and corroborating cycles and indicators that were telling me to anticipate this and to expect it to keep unfolding in a similar manner to what the previous multi-year rally in gold had seen. So after that initial rally back in 2016, gold gave back about 70 to 75% of its initial surge, which is often what you see in a wave 2 pullback. It gives back a lot of what the initial rally gained. Sure enough, very similarly in 2023, gold retraced 70 to 75% of its initial rally during that 5-month sell-off. that brought it into early October 2023 when another very strong convergence of cycles and indicators was telling me to look for a new 6 to 9 month surge in gold. And from there, it would likely enter a wave 3, a third wave, which is in Elliott wave terms and Elliott wave expectations. That's usually a more dynamic, more accelerated move to the upside, where you often see the biggest gains of the overall bull market. And so you had gold set up for that starting in early October of last year. And looking back to the analog of 2016, 2017, you could see that gold rallied for 9 months into September 2017 before it set a 1 to 2 year peak. It didn't drop dramatically from there, but it set a plateau and began to trace out a wide trading range where it banged up against the highs multiple times and then back down to the lows, kind of a sideways trading pattern. But the important point in this analog was that gold had rallied for 9 months into that peak. And so in 2023, 2024, along with a lot of other cycles, I was looking for gold to rally into July 2024, which would be a 9 month advance from that October 2023 low, and then set a peak in July of 2024, where we are now. At the same time, I explained that there was this very uncanny web of related monthly cycles in gold that were saying the same thing. There was a very consistent 7-month, consistent 14-month, and consistent 28-month cycle in gold, all of which should have their next peak, and a very significant one, in July of 2024. So that cycle analog was reinforced by other timing indicators. There were some wave calculations and wave symmetry that were saying the same thing. All of this was telling me to expect gold to move higher into July of 2024 and likely set at least a multi-month peak at that time, and potentially something that holds for longer than that. And that's kind of where we are now. Gold has followed that entire analog of the 2016 through 2018 move up in the current period of late 2022 into mid-2024. It has fulfilled a lot of other things that have been described in our newsletters. And so you have gold coming into a very significant time frame and also bumping up against some very critical price levels between 2450 and 2500, where it could set a pretty significant peak. But that is a perfect example of one of these analogous periods in the market. And there are a couple others that I'm watching, but they're, like I said, more of a rare phenomenon that you don't see or don't expect to see on a consistent basis.
What do cycle analogs reveal for stocks in the coming months?
Well, it's funny because the stock indexes are one of the other markets where I have been monitoring a couple of parallels, a couple of analogs that I think and thought back over the last 6 months would be very significant. And one of those is based on a much longer term cycle, and it's what I described as a potential 56-year parallel to how the market traded in the late 60s and early 70s. And it was intriguing to me because there's a very consistent 7-year and 14-year cycle in the stock market. And so a 56-year cycle is just a multiple of those, 8 of the 7-year, 4 of the 14-year. There has even been a fairly consistent 28-year cycle. You look at the moves and the peaks and valleys between 1973 and 2001. and you have some cycle correlation there on a 28-year basis. So a 56-year cycle in parallel is not unprecedented or not that unusual, but it's also interesting to me that so many other long-term cycle analysis kind of dovetails with that. And you have the Kondratiev wave, which is roughly a 55-year economic cycle. And you've got what is it called? The lunar-based calendar cycle. It's a 19-year cycle, and I think it's Metonic cycle. And 3 of those 19-year cycles brings you into a 57-year cycle. And so you have a lot of longer-term economic cycles, natural cycles, all surrounding this 56-year cycle. So again, it's not something that is unusual or unprecedented, but I started to describe late last year and early this year why I thought that the markets already were tracing out some parallels to the late 60s and why we could continue to see something like that. And the conclusion, I'll get the conclusion first and then pull back to a couple of the phases of that analog that I described. But the conclusion was that we would see an initial high in stocks in the first quarter of 2024, and you would see a series of sequential highs with a final high likely stretching into September or October of 2024. And there's another analog that I'll get to in a second that also showed you should see a pretty significant peak in between those two in July of 2024. But going back to that 56-year analog, I kind of described how you look back to 1966, and I was particularly focused on the broader market, some of the small to mid-cap stocks, because so often you get the Dow Industrials kind of making its moves and diverging from other markets because of a couple of stocks. And now in the last decade or two, you have the NASDAQ 100 and to a lesser extent the S&P 500 often surging to higher highs than all the other indexes used to be based on 5 stocks, the FANG stocks, now based on the Magnificent Seven. A lot of this year was based on NVIDIA and to a lesser extent some of those other stocks. So the point being that some of those indexes mask what the broader market is going through on a longer-term cycle basis. They make it look sometimes stronger and occasionally weaker than what the majority of stocks are showing. But so in this analog, I was talking more about what I expected indexes like the Russell 2000, the Dow Transports, even the S&P Mid-Cap to do during this period in the 2020s, and comparing that to what had gone on in the Dow Industrials back in the late 60s. So getting back to my point here in the phases that I was talking about, in 1966, you had stocks set a 1 to 3 year peak in January of 66, and then they sold off into September of 66 when they set a 1 to 3 year low. Well, 56 years later in 2022, stocks did almost the exact same thing. They set a 1 to 3 year peak, particularly in those secondary indexes that I'm talking about now, set that in January of 2022 and sold off into September 2022 when they set a 1 to 3 year low. In 1966, that timed an initial, what you might call an A-wave low of a much bigger consolidation phase, and then it spurred a rally into late 1968 when you had a B-wave peak that retested the 1966 highs. And so in 2022, I was describing how in the next 2 to 3 years, we could see something similar where those secondary indexes set lows in September of 2022 and then work higher for the next couple years and ultimately top out in September or October of 2024, possibly with a retest of their 2022 highs. And there was a lot more to this analog. There's actually several more phases, but I don't want to belabor this while we're talking. But I've described it in my Inside Track newsletter, all reinforcing that idea that stocks could wait until the latter part of 2024 to set a new 1 to 2 year peak. And the intriguing thing about that, to me, was that it also played very closely into the 17-year cycle that I've talked about so much over the last 20 years, but really started to talk about again in late 2023, because 2024 is the latest phase of that 17-year cycle, tied to peaks in 2007, in 1990, in 1973, in 1956, in 1939. You get that 17-year cycle that has timed very significant peaks. And so I was looking for a little bit of an analog to 2007 in 2024, and that played in perfectly with all of these other cycles. If you look at 2007, the stock indexes set initial peaks in the first quarter. They sold off a little bit, then they rallied to higher highs in July of 2007, and they sold off into August, then they rallied into October and set a final peak then. But it wasn't just 2007 that was part of this analog or comparable period that I was watching. In 1990, you also had a significant peak in July, just as you had in 2007. And going back to 1973, you had a secondary high in July, and then another high in October. So you had a couple of these analog periods reinforcing what several of these other cycles and indicators were already showing. And so my kind of broad stroke sketch of what I expect in 2024 has been consistent with that, and has also been reinforced by the unfolding action so far. And we've seen initial highs in the first quarter. We saw that sell off into April 19th. Then you've had the recovery since then, and now several of the indexes spiking to new highs in July, just as they did in 2007, just as they did in 1990. And I think we could be getting close to an intermediate peak, and that we could see a similar sell-off into August, as we did 17 years ago. And as long as the primary stock indexes hold intra-year support levels and intra-year trend support that I've laid out in my publications, then I would still expect the next phase of that analog to unfold, where we move higher, or at least back up to retest the July highs out ideally in October. But as we get closer, more intermediate and short-term cycles will probably hone that and could even tweak it a little bit one way or the other. But that's another perfect example of these analogous periods that occasionally come up in the markets, or there's reasons to anticipate them, and they serve as an important backdrop. They're not something that you should really be trading off of. They're not that specific that they provide really good risk management, which is the key to all of this, bringing it down to a realistic trading strategy that you can apply to the market. So there's something that just serves as a foundation or a backdrop for expectations, and then I look for other things to corroborate them.
How is the interest rate cycle looking?
Interest rates are still adhering to the broader cycles that I see in bonds and notes. I'm still looking for this latest rally to extend probably into early August. That is actually when bonds and notes saw peaks in each of the last 3 years, and also back at the 2020 peak. You had early July and early August highs that then ushered in the start of a major bear market. So from that perspective, I think you're going to see bonds and notes rally into early August. Perhaps that has something to do with what I was just discussing in stock indexes, or maybe they're independent moves. But from there, I think that you'll see some consolidation. There are some cycle lows that I'm watching out in October for bonds and notes, and so it's the inverse for interest rates. But cycle lows where I think we could see secondary lows in those markets. But from a 1 to 2 year perspective, I think that bonds and notes could then see another up move in late 2024, early 2025. So that would be the time when you'd probably see interest rates moving lower.
What do you see in the cycle for the U.S. dollar?
The dollar is one of the keys, I think, to a lot of what I expect over the next 1 to 3 years. And I think it's going to move in sync with some of these interest rate expectations and price movement. But I think there's going to be continuing to build a pressure to unseat the dollar as the global reserve kingpin. And I always have to throw in the caveat when I say that I'm not saying that suddenly the dollar just collapses and everyone stops using it or something like that. Nothing of the sort. What I'm saying is that alliances like the BRICS nations and other related global economic alliances will continue to have a slow but steady success at pivoting away from the dollar in global trade, or at least in trade between those nations. But as they get more and more very sizable, populous nations, it becomes that much more of a significant impact. And it would only take maybe a 10% reduction in U.S. dollar usage in global trade to have a very significant impact, not only on the dollar's value, but on a lot of other things U.S.-based, from stocks to bonds to commodities and things that are exported and imported. It could have a pretty significant impact. And that kind of goes along with my thinking that we could see another inflationary period starting next year. And that could be linked to the dollar starting to sell off a little bit more significantly. Right now, I think that the dollar is coming down to some critical support that I've described between 102.80 and 103.20 in the September dollar index futures. And it wouldn't surprise me to see it hold there and start to move up higher in the intermediate term. That even goes along with my expectations that gold is at or very near a significant peak. So if you see the dollar start to gain some ground on an intermediate basis, that could be one of the things that weighs a little bit on gold and silver. But looking out a little longer, I think that the dollar has some serious challenges ahead over the next couple of years.
On July 10th, your weekly relay explained that Bitcoin had bottomed and it triggered a new buy signal 3 days before the Trump shooting spurred a surge in cryptos. How significant is that signal?
Well, from an overall position within the trend and wave structure within cryptos, I don't know that it's going to spur a major advance. When that buy signal was triggered, it showed that Bitcoin and Ethereum should move higher into cycles in mid-August. And there are some price objectives that are starting to take hold. But it's one of those things where it just reinforces that Bitcoin has become the real safe haven of choice or place where speculators run when there is geopolitical uncertainty. And so you had a couple days after the buy signal was triggered of Bitcoin starting to build a little bit of a base and reinforcing that buy signal. Then you had the events of last weekend, and next thing you know, Bitcoin was $5,000 or more dollars higher in a day. And so it's even as something like gold had a little bit of a bump, bonds hardly anything. So things that used to be safe haven or places that speculators would run to when they thought that instability might grow, you don't see that as much. Now, the fact that that event was very quickly resolved, for lack of a better term, and that at the time it was a presidential candidate and not the president in office. By the time the markets opened on Sunday evening, Monday morning, there was already a lot of clarity that had been gained in the markets to quell any big surge in some of those other markets. But Bitcoin, it showed that it had other factors that were still supporting it and maintaining its overall uptrend. And so I think that you could see it head back to its mid-March highs, and there's a couple targets a little above that. But if nothing else triggers any acceleration higher in the next few weeks, we could see another significant peak come into play at that time.
Gold's been breaking out to new highs. What are you seeing in the gold cycle?
Well, I still think that gold is actually heading into a peak. I think it's doing on a weekly basis there's a lot of similarities to what it did on a monthly basis back in 2020 through 2022. So I suppose you could call that a little bit of an analog or an analogous period, but maybe a more accurate definition would be a fractal, where a market will often repeat patterns within a trend on different magnitudes or on different time frames. So back in 2020 through 2022, you saw gold move up to similar highs in three intervals. And each time it pulled back, although the first two times the pullbacks or the sell-offs were a little greater in magnitude in sequence. You had the initial sell-off, and then the second sell-off was a little bit more than the first one. But then following that third peak in early 2022, you saw a lesser sell-off, and then gold was preparing for a breakout to the upside in 2022, 2023. And on a weekly basis or even daily basis, you're kind of seeing something similar, where gold set initial highs in late April, then again in May, both right around that 2450 level. And now this week we've just had a spike a little bit above that 2450 level, fulfilling all of those July cycles that I talked about. But gold hasn't shown any signs of following through. And the real key to me is going to be Friday's close in the market, because gold's weekly trend had given this signal back in late June that I discussed in my weekly relay, and explained why that signal should trigger a sharp 2 to 3 week rally. and that as long as it didn't give a new bullish trend signal at the culmination of that rally, then it would likely be a double, or in this case, triple top, and you'd see some selling follow that. So gold set up this signal. It gave the two initial weeks of rallies in the first half of July, and as of the July 12th close in gold and the start of this week's trading, my focus is on the July 19th weekly close. That gold would need to close above 24.30 in the August COMEX gold futures contract to give a little bit more bullish sign. But inversely, if it is able to drop back and close at or below 24.30 on the 19th, then gold would be corroborating this overall pattern, this overall signal, and setting up for a more significant top.
What's the story for silver?
Silver is similar, but silver moves on a little bit different rhythm, a little bit different cycles. And when silver was bottoming in late January and then again retesting those lows about a month and a half later, it was tracing out a very consistent 15-week cycle, and that cycle is telling me to look for an overall surge into the middle half of May when silver could set a more significant peak. And it wasn't just that 15-week cycle in silver. It was a lot of monthly and year-to-year cycles that were all arguing for a peak in May for silver. And so you've had silver now rebound along with gold's rally, but it's showing signs of struggling, and it's looking like it's not going to retest its May high. And so that could usher in a little bit sharper of a sell-off in the second half of July if silver is able to trigger a daily trend sell signal, which I just described in my alert last night. But that could trigger, like I said, a little bit more downside in silver. I think that silver is probably going to stay in a wide trading range for a couple more months here.
What's the story for crude and cycles?
Crude has been kind of focused on some pretty significant cycles in July. When it bottomed in December, I discussed this 7-month cycle that has been fairly consistent in crude, and all the focus was projecting out to July. And you've seen crude get back up towards its recent highs. You've seen some divergence between crude and the products, and it has shown me that it likely set a multi-week top, perhaps a 1 to 2 month peak a couple weeks ago. And so I'm looking for crude to also kind of be in a wider trading range here for the coming weeks and potentially months.
Eric, where can our listeners follow you and subscribe to Inside Track?
The best place is always at our primary website, InsideTrackTrading.com, and that inside is spelled with the extra I in the middle, so it is INSIIDE, TrackTrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim. My pleasure.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, Hilliard MacBeth, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Hilliard, welcome back to This Week in Money.
It's always a pleasure to be on your show, Jim.
The second edition of your book, When the Bubble Bursts, is available. Can you tell us about it and where people can get it?
Yeah, so the book came out in 2018, and it goes through the whole problem in the Canadian housing market and the debt that's associated with that. And actually, there was an interesting op-ed in the Globe and Mail on Monday, the business section, talking exactly about that problem. So since 2018, the problem has just gotten exponentially worse. And obviously, my thesis looks like it's going to turn out to be correct, but it was definitely early in the timing. And the issue is that house prices and the debt associated with housing has gone up much faster than inflation and much faster than the incomes that would support it. So the lenders were accommodating for a long time in terms of expanding the rules and maybe looking the other way a little bit in terms of people qualifying for those very large mortgages. But now we're starting to find that house prices have come down in the Toronto area substantially, and so it's an interesting read now in the context of what's actually happening in real time now.
The Dow hit 41,000 points, the S&P 500, 5,600, and the NASDAQ 18,000. What do you see ahead for the stock markets?
So we've had quite the run. So if you go back to 2020, in March of 2020, the market dropped 38%, and the S&P 500 was in the 2,000 range at the bottom. It only stayed at the bottom for a few days or a week or so, and then it rallied very sharply once people realized that the world wasn't going to end after all. And now it's more than doubled. In fact, it's not that far from a triple. So that's an incredible run, and what's really driving the market, and that's why the NASDAQ and the S&P are so much ahead of the Dow Jones, is what they call the Magnificent Seven: Microsoft and Nvidia and some of those stocks like Facebook and Netflix, and Tesla's in there as well, although some people say it shouldn't be. So these stocks are worth $3 trillion. A couple of them are, and it's dominating the market. Almost all of the gains this year have come from those stocks, and so that spills more into the NASDAQ and the S&P 500 than it does in the Dow Jones. So we're at the end of a pretty long run. I guess you could say it started in 2009, or you could say it started in 2020. But these cycles generally last anywhere from 4 to 5 to 6 to 7 years, and we're probably close to the end of this run. And what would end it would be a recession. So there's signs. The classic indicator is if unemployment goes up by 0.5%, then a recession always follows. Or actually, technically, you're already in a recession when you get that much of an increase in unemployment. There's a couple of different ways of measuring it, and but in the month of June, based on how some people calculate it, we've already breached that. The unemployment rate was 3.5, now it's 4.1, so it's actually 0.6%. But in any case, we're probably there. So we're probably already in a recession, and the stock market will not survive. Even when the Fed cuts interest rates, and they will cut interest rates aggressively, probably starting in September, it won't be enough. The Fed is always late on these things, and the recession has already started in June or July. Then by the time they start cutting in September, it won't have much impact at that point. We'll be well into the grips of a recession. And it's likely it's going to be a difficult recession, not just your ordinary average recession, because the debt levels are so much higher. Just to take one example, in 2016, the total debt of the federal government of the United States was $16 trillion, and it's now $32 trillion. So it's gone up by that much just in 8 short years. It's doubled. And similarly in the private sector debt and the household debt. So it's going to be very difficult for people to manage a recession with that kind of debt load. Obviously, the government isn't going to raise taxes in the middle of a recession, so they're just going to pile up more debt. and that's going to be the challenging thing. How do you finance that debt? How do you roll over that debt? So I'm thinking we're pretty close to the top of this market, and we'll have another one of those bear markets that we haven't had for a while. And other than that brief blip in 2020, you have to go all the way back to 2009 to remember what a bear market feels like.
Gold keeps hitting new all-time highs. What do you see ahead for gold?
So gold's had a great run, and finally, because I think you and I have talked about the gold miners in the past, they're finally responding. So most of all the gold miners that we own and follow were trading at their 52-week highs a couple of days ago. And gold's up around $2,400. It's actually, if you adjust for inflation, the previous peak was $850 in 1980. And to get to this equivalent after inflation, you have to get to about $3,200. And I would expect that we would get there on this run. The reason being, with that amount of federal debt in the U.S., the interest rates will probably, in a recession, have to come down, even though that the U.S. has way too much debt. So in that scenario, that would be very helpful of gold, because people will start getting afraid of holding U.S. treasuries, unless the interest rates were really attractive to hold U.S. treasuries. But in a recession, they're likely to be lowered. The interest rates will be lowered, and people will find it less attractive than holding gold. So usually gold does poorly when the interest rate is above the rate of inflation, and gold does really well when the interest rates are below the rate of inflation. Of course, there's lots of exceptions to that rule, but that's the general rule.
Is gold a good indicator of inflation?
Well, it doesn't seem to be as important. You know, gold and inflation are not as highly correlated as you think they would be. The really great time for gold, though, is if interest rates are low and inflation is high, which, you know, we had inflation peaked at 9% in June of 2022 in the U.S., and interest rates were nowhere near 9%. So that was good times for gold. Then inflation has come down now, and interest rates have stayed high. So now we've got a really surprising situation where gold is actually strong, even though interest rates are relatively high in relation to inflation. But I think that's because people don't really believe the inflation numbers. They don't expect the interest rates are going to stay high for very long. You know, the cuts have been coming for a while. It's been quite a long time. I think it's been a year since they cut the interest rates. They haven't raised them, but they haven't cut them. So the 5.25% has been stable for quite a long time. The next move is almost for sure going to be a cut, and that'll help gold quite a bit.
What do you think the Bank of Canada will do this coming week and the Fed the following week?
So they don't expect any big moves in the July meeting in the U.S. It's not one of those major meetings where they have a summary of the monetary policy report and that sort of thing. It's kind of like an in-between meeting. It's possible they might surprise us with a cut from 5.25 down to 5 at the July meeting, but most people think it's not going to happen until the September meeting, which is one of the more concrete meetings that they hold during the year. But you never know. You might get a surprise. The Bank of Canada's already cut once, so almost for sure the Bank of Canada will not cut a second time, because they're already ahead of the U.S. Federal Reserve with having cut, and the U.S. has not stayed held it high. So I suspect the Bank of Canada will just stay pat, and Europe just a day ago kept their rate unchanged, and I suspect that's what's going to happen in Canada and the U.S. as well. But September we'll start to see the start of the cuts, and there'll be a cut in November and probably another one in December after that too.
Are there scenarios where interest rates could see double digits like we saw in the early 1980s?
So I think that would come later. So if I'm right about a recession having already started or just about to start, the rates are going to go down for a while before they go up. But that debt isn't going to go away during a recession. It's actually going to get bigger during a recession. So on the next expansionary phase, whenever that starts, maybe in the end of 2025 or the middle of 2025, that's when you could see interest rates going even higher than they went last time. So when as I mentioned, inflation at 9%, interest rates never went much above 5.5%. So on the next round, if we got another burst of inflation, then the interest rates will go up much faster than they did last time. The last time, the Federal Reserve doesn't control all the interest rates, just controls their Fed funds rate. But people watch the Fed funds rate as an indicator, and the Fed was very slow to start raising rates last time. Basically, they left it for quite a while, and they raised the rates very, very, very small increments. They raised the rates 11 times, but they started late, and they kept raising rates long after inflation had peaked. So on the next round, if we get another outburst of inflation, and I don't know if we will, we could just as easily go into deflation, I guess, but the odds are it'll probably be inflation because of this massive debt that we have. Then the Fed will probably move more quickly to raise interest rates faster the next time, having made that mistake the last time.
Do you think potential buyers will continue to hold off purchasing homes waiting for additional interest rate cuts? Yes,
I do. It's interesting. The Toronto market is struggling pretty much, and the headline numbers are home prices are down 5-10% in Toronto, and maybe 15-20% outside of Toronto, and that's sort of the way it's been for a few months now. But there's a massive glut of condominiums in the Toronto area that are for sale. I was just looking at it this morning, just because I saw a tweet from somebody about it, and the sales are half of what they would normally be, and there's a very large number of listings for condos. So I looked at some of the individual things, and it's just crazy, 500 square foot condo for $1 million and that sort of thing. Just nobody's going to pay that. So they were only paying that in the middle of a frenzy, but when the frenzy ends and then you get the cold, cruel light of dawn and you look at it, it's like, wow, that doesn't make any sense at all. They can't rent the condos out for anything like the amount of rent they need to cover their costs. So, and then of course on the other side you've got the new home builders who are, they've had a great run. They've had I don't know how far back it goes all the way back to 2008, 2009. So that's more than 10 years, 15 years almost, where they could sell more every year. And then in the last 12 months, there's been the story about immigrants coming in. Although most of those immigrants are students, they're not going to buy a home, but it's a good story. And at any rate, that's where you'll get the problem. You get from two areas: from the condo glut, which people will have to cut their prices, or they'll get foreclosed on, or something like that. The sellers will be forced to reduce their prices, and the new home builders who are very, very reluctant to cut their prices. But once they start cutting prices, or if the lender forces them to cut prices, it can happen pretty quickly because they're not as emotionally attached to any particular price. They just are at that point they're just trying to survive and not go into bankruptcy. So they will slash their prices quite aggressively. So we're not quite there yet, but it could happen anytime. That's the sort of thing. I mean, people look at the winter season and say, well, not very much sells in November, December, January. So we're only we've only got to July, August, September, October left, 4 months left. So if people get sort of into September and they're still sitting on a whole bunch of inventory that they need to sell, you might see some really good bargains. So I think most people are aware of this. They're starting to become aware of it. And just talked to some people today that are moving to Vancouver, and they're going to rent for a while and just see what happens. I mean, the rents are high. I mean, it's $4,000 a month or something like that, $3,000 or $4,000 a month for a nice place. But if what you're trying to buy is coming down at $10,000 a month or $20,000 a month, then you're much better off to pay the rent and wait a year and maybe save $100,000 or maybe $200,000 on the purchase price. So that's kind of where it is now, I think.
Are you seeing signs of the real estate bubble bursting in residential and commercial real estate?
Oh, absolutely. So we just talked about residential, but let's talk about commercial. It's just amazing what's happening. Now, we don't see as much in Canada because a lot of the Canadian stuff in office towers, especially, which is where the big drama stories are coming out, is in the office tower space. A lot of them are owned by pension plans and life insurance companies, and they tend to be very long-term thinkers. And in their accounting, they don't have to mark to market, so they don't have to admit to their shareholders or anybody that the price is much lower than what they paid for it in the purchase price. So they can just hold on and wait for the prices. In their minds, they're thinking the prices will go back up. But in the U.S., you get a lot more instances where investors and traders have bought these properties, and they may be forced by the lenders or somebody to mark the price down. Or in the case of a recent one just in San Francisco, Goldman Sachs and Brookfield were the owners, and I think Royal Bank was one of the lenders. The Canadian Bank got in there somehow, and some other banks, and they basically those types of loans, unlike a house in Canada, with those type of loans, the owner with basically zero equity left in the building can just walk away, and then it becomes the lender's problem. The lenders take it over. They don't pay any money for taking it over. They just assume ownership of it. And but in every case now, the debts are much higher than the value of the property. So the example is like this was a very big one, the San Francisco one. It was several buildings, and it was, I think, close to $1 billion, and they had $685 million in debt. But the initial purchase was much higher than the debt, but now they're just walking away from it, and the value's probably dropped from $1 billion down to 400 or 500 million. So now it's the lender's problem, and they're going to lose 180 million or 200 million on when they finally end up selling it, if they sell it or if they hang on to it. Usually, in that situation, the lenders are fairly eager to sell, but if there's no buyers, they may just hang on to it.
Do residential real estate bubbles burst from the top down? Well,
it's interesting. If you're thinking about when you say top, you mean the house prices or the property prices. The sales right now have pretty much dried up in the really high end markets in most Canadian cities. There's quite a bit of activity in Edmonton, Calgary, in the average price homes, like the 500, 600,000. But in the high ends of 2 or 3 million, which is the high end in Edmonton and Calgary, there's almost no transactions going on. And a lot of times those people don't need to sell. They're just like maybe retiring, wanting to downsize, and so they'll just stay in their house for another year or two. So it's but the weight, it's where I think it's not so much the top so much as where the real pressure comes from when the bubble bursts is who's the most heavily indebted. So the heavily indebted properties, whether they be 3 million or 500,000, those are the ones that trigger or accelerate the burst in the bubble. So if we're in inning number 2 of a 9-inning ball game, what accelerates it is when these heavily indebted properties, whether they were speculators or just couples that got in over their heads and whatever, they're the ones that end up pushing the prices lower because they're forced to put it on the market, usually by the lender. The lender pushes them into it, or they sell. There's a lot of stories now in various outlets about people that see a renewal coming up for their mortgages, the 5-year renewal or the variable rate, forced to convert it to higher rates. They are selling and because they can see that they won't be able to afford it at the new higher rates. So the bubbles generally get accelerated. They burst. They start to burst. Then the accelerant is the amount of debt that's involved in the property, whether it be a condo or a home or commercial real estate. It's pretty much all the same. It's all about the debt.
Do real estate markets tend to collapse in the fall?
Yeah, I don't know about that. There's definitely a stock market situation in the fall. The September, October are the 2 worst months, and it goes back decades and decades of data. And one theory, I don't know if this is right or not. I have never seen a definitive analysis of this, but it kind of makes sense. Is in the banking world, going back hundreds of years, a lot of the lending was related to the crop cycle. So the farmers would borrow money in April, May, and to get seed and to get some money they need for fuel for their equipment to plant the crop. And then in September, when they had the harvest, or October, they would pay off the loan with the proceeds. So where you'd get a crisis would be if there was a failure in the crop, and those borrowers couldn't pay back the loans, and then the banks were in trouble. The banks got in trouble, and that caused the banks to have to call in a bunch of other loans. Well, the easiest loan for the bank to call in is the loans to the stock market operators. So those loans, the margin loans, are all demand loans. They can be called in, not just any day, but any minute of any day. There's no notice required, so it's an instantaneous call, and the stockbroker firm has to get the client or the trader to come up with some more collateral, or they have to sell the stocks into the market. So a lot of times, if you're in a real hyper elevated bull market, frothy market, the people can't come up with the money. The margin call goes out, and there's no money comes in, and the bank forces the stockbroker to sell stocks to cover the loan. And that happened in 2007, by the way. And the market went down 20% on a Monday. October 19th was the actual date. And Tuesday morning, the Federal Reserve, with Alan Greenspan, phoned all the stockbroker companies like Goldman Sachs and Morgan Stanley and all those companies and said, do not sell stocks into the rally. We will lend you as much money as you need to cover all the margin loans. So that was done behind closed doors. Nobody really knew. It came out a few years later, but the market recovered from that day forward. By the end of the year, that was in October, by the end of the year, the market was higher than it had been in October. So that October crash scenario can be avoided if the Federal Reserve or the Bank of Canada or somebody stepped up with a bunch of money to lend. But if it doesn't, which is more normal, normally the Federal Reserve wouldn't step in like that, then you can get some pretty big sell-offs in September, October.
Could some credit unions be in jeopardy in Canada?
Well, credit unions are, they're of course, they're kind of like mutual societies where they basically exist to meet the needs of their membership. And the membership, for the last how many years now in Canada, have wanted to buy properties, whether for themselves or sometimes as speculations as an investment, or maybe for their adult kids, or even now their grandchildren. I guess they're helping their grandchildren buy houses. So out of necessity, in order to meet the needs of their membership, the credit unions have all gotten heavily involved, and very heavily involved, in residential real estate. And so if residential real estate prices go down 20 or 30% or more, as they would in a true bursting of a bubble, then the credit unions will be in trouble. Now, they do have different regulatory environments, and they've got different backing. In Alberta, for example, the government of Alberta backs all of the credit unions, so they can't fail because it's basically the government that backs them. And I don't think they'd be allowed to fail widespread, but they could be in a situation where they have real difficulty making any new loans because they're so tied up in a bunch of loans they made previously that are underwater. And so that's probably where it's headed in this case, because certainly the level of sophistication in the lending departments in credit unions is not nearly as high as it would be in the banks in Toronto or Vancouver. Although there could be some very sophisticated credit unions, so some of the larger ones have hired some people, but even the most sophisticated lending departments in the country have gotten over their heads into real estate. So sophistication doesn't necessarily protect you from making mistakes when it comes to residential real estate. Once everybody starts to believe that the prices can never go down, they can only go up, even the largest bank will make the mistake of making too many loans.
What's considered wealthy in Canada?
Well, yeah, I don't know. It's the old 1% rule. I think in Canada the 1% rule is you have to make something like $300,000 a year, or have assets of $2 million or something like that, and non household, not in your house equity, but just in investments outside of that. I saw a report a while ago. I don't remember the exact numbers, but in New York City, it's much, much higher. You have to be making over $1 million a year, or have assets of $5 or $10 million to be in the 1% in New York City. So it depends on where you are, in which city or where you live, and that sort of thing. But certainly, there aren't as many wealthy people in Canada as there are in the U.S., and there aren't as many wealthy people as house prices would indicate. So you've got it looks like every third person is a millionaire in Canada because of house prices, but in reality, it's not like that. The two highest average incomes, household income in Canada, were in Calgary and Edmonton. They were around 100,000, and all the other cities, including Toronto, were lower than that. So, an average house price of $1 million in Toronto doesn't make any sense when the average household income is less than 100,000. It's 10 times ratio is just ridiculous, and those are the numbers that show up. Vancouver's even higher. Vancouver's at 12 or 13 times, and of course it depends on the mix of older people who don't have income so much as they just have wealth. Maybe they brought it from another country or something like that. Maybe there's money laundering involved. Who knows? But if you just take the straight average working people, you need to have a much, much higher income than 100,000 to be in the 1%. And yet, somehow they find the money to buy these $1 million, and that's the average price. 1.1 million is the average price for a house, right? So it's not even so the half the people are above that. So it doesn't make sense, really. The whole thing, we've gone way beyond what the average person can afford in Canada. And in many cases, even if they're in the top 1%, they're stretched beyond what they can afford.
What are some of the tax loopholes in Canada for the wealthy?
Well, they don't call them loopholes, but the exemptions. One of the things that kind of interesting is if you're an employee, and you generally, there aren't very many ways to get out of paying your tax because you get paid. Even if you're a high income person at $500,000 or $1 million a year, you get a T4 and you have to pay your taxes, and then you try and look for deductions that you could make against that. But if you have a corporation, if you're lucky enough to be in a situation where you've got a corporation, there's a lot more strategies that you can take advantage of. And that's why this latest change in the capital gains tax rate was so upsetting to a lot of people that have corporations, for instance, doctors or lawyers that have incorporated, because they changed the inclusion rate from 50% of the capital gain to 66 2/3%. And I'm sure there were people that believe that capital gains should be taxed just as much as work. There's a strong trend going back decades in economic theory that income in a dollar is a dollar is a dollar. The commission in 1971, that was one of the titles of their paper, and so it should be taxed equally with income that somebody makes from being a bus driver, for example. But that never got implemented. So if you're lucky enough to be a doctor making a bunch of money and you can put it through a professional corporation, as they're called, then you can shelter it. Essentially the idea was it was supposed to be equal to if you made that money as an employee. But over the years, there's been some ways to maybe at least delay the taxes, if not avoid them altogether. So in June, the government of Canada, the Trudeau government, suggested that, or didn't suggest it, they went ahead and implemented an increase from 50% on capital gains to 66 2/3% on capital gains. So they said on individuals, the first 250,000 wouldn't be affected, but on corporations it would be from the first dollar. So people that had corporations were disadvantaged quite a bit compared to the person that was just doing an individual tax return. But in general, there aren't very many ways to avoid the taxes, unless you're in the very, very wealthy category, and I'm talking like $100 million, that sort of thing. And then, of course, there's all kinds of ways using offshore domiciles and that sort of thing to try and get around some of the taxes that are involved. But even then, it's difficult because you can't just put your money in an offshore trust account. You have to actually leave Canada, emigrate, and take up residence in Grand Cayman Islands or something like that. And that's something that most people don't want to do.
Well, virtually every former Canadian Prime Minister was in the Panama Papers. Other countries took moves to collect unpaid taxes. Canada didn't.
Yeah, and that was a situation where that was a secret, right? So if the law firm hadn't released, or some insider hadn't got a hold of the documents from the law firm in Panama, indicated all these corporations that had been created and money had been transferred to them. Because in reality, under the tax laws, you still have to pay tax on that money, so you have to somehow find a way to keep it secret. And that was what was so shocking about that, was there were a bunch of people that were discovered to have gone through that. Now, some of the people hadn't put any money into these corporations; they just set them up and then never used them, or if they'd used them, the money had been moved on to someplace else since then. But yeah, if you're in that category, if you get into the very top categories, like, as I say, you're not talking 1%, you're talking 0.1% or 0.01%, then there are a lot more options available to avoid taxes. But obviously 99.9% of the people aren't in that situation, so they don't have to worry about that.
Yeah, where do you plan to register your super yacht?
Yeah, exactly. And there's even a cruise company that has because residence really matters when you get into these strategies. And there's a cruise company that's got a ship that travels around the world 24 hours a day, 365 days a year. So that you take residence on this cruise ship, you never land. You're allowed to leave the ship to go ashore and have a holiday or something, but your residence is considered to be on that ship. So then you don't pay taxes to any jurisdiction as long as you don't visit it for too long. And that's kind of drastic. But once you get into those categories, you can afford to do drastic things like that. But the rest of us just have to pay our taxes.
Yeah, your occupation is listed as seafarer. Yeah, tax free.
Well, one of the good things is kind of difficult to take advantage of this, but one of the good exemptions, and I think it's up to about 1.1 million, is it goes up with inflation every year. Is if you own a qualifying private corporation, and you can sell the corporation to another person, you can get a 1.1 million tax-free capital gain. And same with a farmer. If a farmer sells a farm and it stays in the farming activity, then you can get a break from the gains on that sale. So those are the two main categories that you can actually do it. And there's some other strategies with corporations. If you have a bunch of money in a corporation, you can buy a life insurance policy have the corporation pay for a life insurance policy, and you can avoid taxes that way. That's the good news. The bad news is you have to die to collect on that. So it's kind of drastic.
Tax cuts are always an interesting topic. Do you think people keeping more money in their pockets is more productive than paying more taxes to the various levels of government?
Well, I don't see where tax cuts are going to... I don't know about Canada, but the big one that's... what I'm going to say is about U.S., but it's true in Canada as well to some degree. So that I mentioned, I think the deficit is $2 trillion in the U.S. on an annual basis, and the total debt has gone up from $16 trillion 8 years ago to $32 trillion. So it's doubled in just 8 years, which is phenomenal, right? Just phenomenal. And of course, most people will focus on the fact that spending has increased, which is true, especially during COVID. There was a huge increase from 2020 to 2022 in government spending because a bunch of support programs kicked in. We had them in Canada, and we had them in bigger in Canada than the U.S., but everywhere they had them. The deficits and the debts of government debt ballooned under that. But the other reason that the deficit's gotten so large in the U.S., and $2 trillion is very large. Like I can talk in a minute about what that would be. What would be required to get it down to even $1 trillion be phenomenal. But these numbers are so large that, for instance, in the U.S., defense spending is one of their biggest categories that's considered discretionary. There's very little discretionary in the budget in the U.S. It's almost all legislated, whether it be Medicare, Medicaid, education. All those things are legislated. They can't. The politicians can't pass it. Say, oh, let's change the budget. They have to follow the law. But there's one major discretionary item, it's defense spending. So they can change it. They never lower it because anybody that wanted to lower it would be very unpopular. But it's 800 or 850 billion. So I mentioned the deficit's $2 trillion. So even if they eliminated every dollar on defense, which of course never going to happen, they still wouldn't even get the deficit cut in half. So on $32 trillion worth of debt that's accumulated, the average interest rate on that the U.S. government's paying right now is about 3%, and it's going to go up because interest rates have gone up recently. So as the bonds mature, they'll have to reborrow that money at higher rates. But at the moment, I think it's about 3%. That's close to $1 trillion. So just those two items alone, if they stop paying interest on all their debt and they completely eliminated the Department of Defense, they still wouldn't cover the $2 trillion deficit they have. So by cutting spending, it's impossible to get rid of that deficit. So the only other option would be to increase revenues. Well, revenues come from taxes, right? So the reason the debt ballooned so quickly was one of the reasons, the main reason, was when President Trump was in, he cut corporate taxes from 35% down to 21%, and he cut income taxes on the high-income people substantially. I don't have the exact numbers, but he cut them substantially. So revenues dropped, and then Biden got in, and he said he was going to raise taxes back up. Not all the way back up to where they were before Trump, but part of the way. And of course, he never got around to doing that because it's very difficult to get it passed in the House of Representatives and the Senate. So basically, they're sitting now with lower taxes, higher costs, and the deficit just keeps getting bigger and bigger.
If 50% of government bureaucracy and jobs were eliminated, could the country, provinces, and municipalities still function?
So, if the number of people that are employed in the federal government of Canada is a tiny number of people, right? So it's about 300,000 people in total. It's gone up a lot lately, and there's been a lot of media about how many government workers there are and that sort of thing. It's a pretty small percentage of the total working population count. The total working population is close to 20 million people. So it's a tiny, tiny fraction. It's not even 1% of the total employees in the world. Now, if you go into provincial, then it's bigger because they're responsible for delivering health and education. And those are and it depends on whether you classify teachers as government employees, you classify doctors and nurses as government employees. I don't know. I guess some of them you do, some of them you don't. I don't know how it works exactly. But no, you couldn't possibly cut enough government employees to balance the budget. There's really no way to do it in that way. So one of the areas I think that in the U.S. Where they could actually make some improvement is over successive governments over the last 30 years. They've continued to cut the number of employees in the IRS, and so they've got a huge. I mean, they're talking tens of billions, if not hundreds of billions of dollars in uncollected taxes owing. And all they would have to do would be to hire more people in the IRS, and it's probably true in Canada with the CRA, and just get to be a little bit more aggressive in collecting the taxes. But of course, that has certain political implications too, because people don't like being called by the CRA and the IRS to be reminded that they haven't paid their taxes. So, and they would have to get really aggressive. They'd have to hire a bunch of lawyers and really go after some people. But a lot of the unpaid taxes are you got all kinds of different categories, like people that are in the money laundering category, people that are resident maybe in a different country or something like that, but still owe taxes to Canada. So it's a problem. I mean, I don't know how we're going to solve it. It's not, and do we have to solve it? That's another question. I mean, the government debt and the deficit has been going up in Canada since 1867 and in the U.S. since 1776. It's never really gone down. It's only gone up. So maybe it's a situation where we just have to learn how to live with it.
Trudeau in Canada, Biden in the U.S. have doubled the debt of their countries. They like to blame their predecessors, even though they are the ones that actually doubled the debt with interest rates rising. Is all this debt sustainable?
Well, I think we talked about that quite a bit already. What would happen? There's an interesting movie in the 1970s. It was called Rollover. I think that was the name of the movie, but it was pretty graphic. It was actually quite popular at the time. And basically, what it said was, what if one day the government, and they were talking about the U.S. government, the U.S. movie, went to borrow all this money in the money market, and nobody would buy their bonds. Like, it would be, so that would be the one instance where it would become unsustainable. So one of the biggest holders of the U.S. government bonds is China, and China has actually started to try and lower the amount of money they have on deposit with banks in New York and elsewhere. And they basically instruct that money to stay in the U.S., but they instruct the manager of their money to buy U.S. government bonds. So it's kind of like they build up all these U.S. dollars. They don't want to bring them home to China because it would inflate the local currency. They want to keep the Chinese currency low so their export can continue to sell. And so they keep investing this money in U.S. government bonds because that's the most liquid, the safest thing to put it into. And they've been doing that for decades, and probably 40 years now. It's built up to trillions and trillions of dollars. So if one day the Chinese decided, hey, we're not going to buy your bonds anymore, and Japan's another one, and for the same reason, Japan's the big exporter of stuff to Panasonic, Sony, all these corporations. Toyota were selling goods to the U.S., and they were getting paid in U.S. dollars, and they just kept it in U.S. dollars. They didn't convert it back to the yen or the yuan or anything. So that money's built up over the decades, and there's trillions of dollars floating around like that. But when people start to say, well, what happens if they all of a sudden decide not to buy the U.S. currency anymore? The U.S. currency will collapse, and the world will go into a major financial crisis. But the problem with that analysis is, what would they buy instead? Like, they would have to convert out of the U.S. dollar, which would push the U.S. dollar lower, and they'd have to buy something else. So there just aren't that many options. The euro, maybe, but it's got its own problems. So the one area where governments seem to be buying more of is gold. And this is where you get into the gold bug territory, which I've always been interested in gold, and I kind of like it right now because there's no way that the people they won't be right to say that all of a sudden they're going to sell all the U.S. dollars, but it's quite possible, and maybe even likely, in a trade war between China and the U.S., they're going to stop buying more U.S. dollars. So as they get U.S. dollars, they may start to invest in something else. And the one thing where the Chinese government, and people in China as well, in the private sector, have really increased their buying lately is gold. They've been buying gold, and that's one of the main reasons why it's gone from under $2,000 up to over $2,400 an ounce. So that is, I guess you could say that the U.S. dollar has been the reserve currency of the world, and we don't really have any other alternative. But gold used to be the standard, and the gold standard up until 1971. The U.S. government was on the gold standard, and then maybe the people are voting with their feet and saying we're going to prefer gold over the U.S. dollar. But the really big amounts, it's difficult, and gold isn't very liquid. It's not like the U.S. dollar. You can't just as easily. If you own it, you got to store it somewhere. You got to worry about theft and all that kind of stuff. The U.S. dollar is just a lot easier, and the U.S. dollar is got a lot of gold backing. The largest owner of gold in the world is the U.S. government. So, if you like gold, you kind of have to feel good about U.S. dollars too, because they're not fully backed by gold anymore, but there's a substantial amount of gold in the U.S. At least they say there is. Nobody's been allowed to go in there and investigate. So maybe we'll find out they're just a bunch of bricks painted with gold plate on. They're actually not solid gold, but the official numbers say that the gold is there. So I guess we have to trust that, right?
Well, Germany found out the gold the U.S. shipped it were actually tungsten bars that were gold plated. So no, you can't trust it.
No, that's that German story is interesting. That the Germans moved their gold to the U.S. to take care for safekeeping, as I understand it, during the Second World War. But I think they were worried it was going to fall into the hands of the Russians or something like that. But and then I guess fairly recently they asked for it back.
What's the latest on auto sales in Canada for traditional engines and electric vehicles?
So there's some really strange things happening in the auto market, and it's hard to get a reading on it. One of the things that happened about 2 or 3 weeks ago was all of the automobile dealers in North America were hit by a cyber attack. So they all, apparently, I didn't know this, I don't think anybody knew it except auto dealers, they all use the same software to keep track of their sales and their inventory and all that kind of stuff. So this hack is apparently pretty serious, and they've lost kind of lost all their records, I guess would be maybe an overly simplistic way of stating it. And I don't know the inner details, but it's really thrown a wrench into. So we don't really know how sales are going or how much people are selling, but we know one of the clues we can do is we can look at things like auto financing. So almost all cars are bought now with credit, right? So very few people walk in anymore and pay cash for a car. So the credit markets for auto finance are starting to show a lot of signs of stress. So they keep track of how many auto loans are 30 days, 60 days, 90 days in arrears, and those numbers have started to spike up quite sharply. So people are and then normally you'd also have a report on how many repossessions have happened, but because of the software glitch, we don't have that. But one of the things that we can look at, there's some publicly traded companies. One of them's in Canada, and there's a couple in the U.S. And the one in Canada, his name is Auto Canada, trades on Toronto. They just recently announced that they have negotiated an increase in their credit loan. So every car dealer has to have a loan. It's kind of a revolving line of credit that finances their inventory. And the Auto Canada announced a couple of weeks ago that they have negotiated an increase, but it's only a very small increase. And they only got a small incremental amount, and they've only got till September because they're offside on their covenants, they call them, which is they got to have a certain amount of financial parameters on their balance sheet and in the earnings statement to support that amount of debt. And they renegotiated the line of credit, got a small increase, but they've only been given till September to get back on side because they're offside. So, and I guess that reason for that is because they've had trouble because of this. They've either had trouble because of sales or they've had trouble because of this computer hack. I don't know if we'll ever be able to tell the difference. But on a bigger, if you step back and zoom out a little bit and take a broader view on this, the big problem all these companies have is they don't sell electric cars, and electric cars are beginning to become what people want. I know there's a story out there now that electric cars sales have slowed down, but in the actual numbers, it hasn't slowed very much, and there's a lot of new products coming on the market, a lot of new products, and they're cheaper. They're much cheaper than they were. The cost of the battery especially has come down a lot. So the Chinese have the best new offerings of anybody on the planet, but those cars will not make it into the U.S. Because of the tariff barriers that have been put up. The European market is they're in negotiations right now over new tariffs that Europe wants to put on, and it's because they're terrified of all these new cars, which apparently are better than the existing cars by a mile, and they're cheaper. So companies like BYD, some of the big companies in China that have been around for a long time, and then there's new ones. There's Huawei, the telecommunications company, is now making cars. There's one called NIO. There's Xiaomi's got a car now. There's a whole bunch of brand new cars. People that weren't in the car business that started with a basically a computer on wheels, if you like, which is the right format to start thinking about it. And the legacy automakers like Toyota and Volkswagen are really struggling to try and catch up. They're so far behind already, I don't know if they ever will catch up. So it's a murky picture, but on the long run, we know that there's going to be bankruptcies, there's going to be some big changes, and China is going to be the one that drives most of these changes.
Is China likely to be the big player in electric vehicles going forward?
They already are. They're leading the pack. They have a conference in the spring in Shanghai, and I just listened to a podcast by somebody who had gone there, and they just said they were completely blown away. There's so many new products. The sophistication is way beyond anything that you'll see from Detroit or from the U.S., except maybe for Tesla. And even Tesla's at risk of falling behind. But Tesla is the only North American company that has a chance of keeping up. And of course, Tesla makes cars in their Shanghai plant that are exported all over the world. And you can get a new Model 3 in Canada. You can't get it in the U.S., but you can get it in Canada that's made in Shanghai. And I've seen them, and they're fantastic cars. They're way better than, because as you and I discussed, I've had a Tesla now for 8 years, longer than 8 years now. And each time I've had actually 3, so I trade them in, and my latest one is way better than the first one I had, and now this new Model 3 is way better than the one I currently have. So I don't want to trade it again. I don't want to get onto my 4th Tesla. So anyway, but they're competing. I mean, the competition is absolutely brutal, apparently, and the costs are coming down very rapidly. The battery costs have come down more than 95%. So the battery's the biggest expense in an electric car, of course, and the rest of it is there's a computer and a battery, one or two or three electric motors, which are pretty standard, not really difficult technology. So the main technology is the battery and the computer. And interestingly, Tesla, I don't know about the Chinese ones, but Tesla was using NVIDIA chips, and now they're making their own chips for the computer. But these are very advanced computers that they're putting into cars as well. So one of the issues is these computers that are in the cars are so advanced, and they have, I think Tesla has 8 or 12 cameras that some parts of China, the government has said, we won't allow a Tesla into this area because we're worried that it's collecting data on secrets. We don't want it to learn our secrets, so they won't let the car. So the car's become a spy, basically.
What could happen to North American automakers and their high-paying jobs?
Well, I don't know how many jobs there are anymore in the manufacturing. I mean, some of the car manufacturers they outsource a lot of the manufacturing. A Canadian company, Magna International, they made most of BMW's vehicles in North America for years, but then they just put a BMW sticker on it and said it was a BMW. So, but one of the things about the electric car is it's much more amenable to being built by robots. So that was the other thing that the people on this podcast indicated was they went out a tour of 2 of the factories. I think it was a BYD factory and a Tesla factory in China, and there were very few people in the factories. It's almost all manufactured by robots now, and so that is going to really be difficult for the unions in the U.S. That's why President Biden wouldn't invite Tesla to the conference on electric vehicles, even though Tesla was by far the leading manufacturer in the world at that time of electric vehicles. And instead, they highlighted General Motors because General Motors uses the automakers union, and Tesla does not. So that was what was behind that. But it's going to be very difficult for the unions, very difficult for automobile dealerships, very difficult for the oil and gas business. It's going to impact a lot of people, and yet it's going to be very positive for a lot of people too. Certainly the cost of ownership of a car will come way down, cost of maintenance will come way down, it's going to make transportation much less expensive. So it's a transition. We're going through a big transition, and just to give you one number, there's 20 million barrels of crude oil a day consumed in the U.S., and 9 million of it goes into cars and light trucks. So if even half of those cars and light trucks go electric, we're talking a reduction of 4 million barrels a day, roughly, which is quite a large 20% reduction in the amount of oil consumed. That'll turn the world oil market upside down, because by far the U.S. is the biggest consumer of oil in the world by per capita. So there's just one example of what the transition to electric is going to do, and that is even before you get into buses and trains and even planes. There's a company in the world that's talking about using hydrogen battery power for airplanes, so you would get away from burning kerosene in those jet engines.
Should Canada put tariffs on EVs from China?
Well, they're going to have to, I guess. And former President Trump, perhaps soon to be president again, Trump, is said when he put tariffs on China the last time when he was in office, that he was making so much money off these tariffs. But that isn't the way it works. Tariffs aren't paid by the seller. Tariffs are paid by the consumer. So it might hurt the Chinese in terms of the slowing down the amount of exports that go to North America, but the cars will go to Brazil and Africa and different places, Australia. There's lots of places in the world to sell the cars, and of course they would love to sell more of them in the U.S., but if they can't, they won't. And Biden's already talking, or maybe he's already implemented an increase of 100% tariff on Chinese cars in the U.S. So now there's ways to get around it, and the Chinese will probably do this. They'll probably build a plant in the U.S. to make their Chinese cars, and it's very transferable once you get a plant. Tesla's done this several times. They got all the robots lined up. They know how to do it. It takes them less than a year to build a new plant once they get started, once they get permits. So that would accomplish the thing. But Canada, getting back to your question, Canada won't have any choice if the U.S. puts tariffs on. Canada will have to put tariffs on as well. But it won't help us, because nobody's going to build a plant in Canada to export cars to the U.S. because they're worrying about the what used to be called NAFTA is now called the U.S. CMA, I think, or something like that. The North American Free Trade Agreement. It wouldn't allow, if it even survives the renegotiation when the expiry comes up in about a year from now, I'm sure it won't allow people to make cars in Canada and export them to the U.S. the way we used to have it quite easily now. So people aren't going to take that chance. They're going to want to build the plants in the U.S. to make sure they have. So basically all it will be is we'll just be hurting Canadian consumers by the amount of the tariff. So if Chinese wanted to sell us a fantastic car for $30,000 Canadian and there's a huge tariff on it, we'll end up paying $50,000 Canadian for a car that should be costing $30,000.
Volkswagen is making a car called the Viking in China that's $10,000.
Yeah, I haven't heard about that one. I've heard about the Seagull, which is BYD's car, and it's right around $10,000. And it's actually quite a sophisticated car. I thought maybe they were more like go-karts, but turns out that these are pretty decent cars, and I'm sure Volkswagen's got one. And now most of the time those are sold only in China. They're not exported, right? The ones that they export are in the $30,000-$40,000 range, not the $10,000 range. But in order to be competitive in China, they have to really be aggressive, and that's one of the problems with China manufacturing is there does tend to be the competition is so fierce and so brutal that and there's so many manufacturers that they take all the profit out of it, so it becomes basically impossible to make a profit selling in China. And Tesla's got to be worried about this, I'm sure.
Could changeable batteries be a key to the future adoption of electric vehicles?
So one company in in China called NIO, N-I-O. It trades on the New York Stock Exchange as well as in Shanghai, and it started from the beginning. Say we want to do battery swaps. So, and Tesla looked at doing battery swaps in the beginning, but they decided to build a supercharger network instead. But the interesting thing about battery swaps is for taxi, or Uber or Lyft drivers, that sort of thing, or robo taxis, which are coming, I guess. The swap makes a lot of sense because you're talking about a swap that takes 1 or 2 minutes, done by robots. There's no need for any human intervention, and the car is back on the road with a fully charged battery. The other thing I was reading about NIO just recently, which is really interesting, is the model might be that you subscribe to a service, so you don't actually own the battery. So you buy the car without the batteries. Be way less than $10,000, and then all you do is subscribe to NIO's battery swap service. And so if you know you're just going to be around town for a few weeks or whatever, or a few days, so you just get a small battery for a lesser charge. And if you're planning to do some long distance traveling, you get a battery that could have as many as 1,000 kilometers in it, so you could go on a really long trip. So it makes for a lot of flexibility, and I think that it gets around the issue of the time it takes to recharge batteries. Personally, I don't think it's that big a deal, and I've done lots of long distance traveling and stopped and it's usually between 15 to 45 minutes stop. My car has a range of 600 kilometers, but you don't want it to get down to zero. So after 200 or 300 kilometers, you stop for 15, 20 minutes, maybe have a bathroom break, maybe have lunch. A lot of times the car's ready if you're having lunch, the car's ready before you are to go and resume the trip. So you can charge overnight if you're staying overnight on the trip. So, but for some applications like trucks and buses and taxis, the swap battery would be great. And the world leader is NIO, and the company's only like about 5 or 6 years old, I think, and they're still not making a profit, but they're coming on really fast. And Tesla didn't make a profit for a long time, and everybody said, "Oh, it's going to go bankrupt because it's not making a profit." Well, it was reinvesting in its growth, right? And so now it's making lots of profits, and it depends on what phase of growth you're in and whether you can actually produce a profit or not. But NIO is not profitable yet, but I think if they can get this swap thing going, they could very well be a powerhouse in the future.
Where are driverless cars and buses being used, and how are they doing?
So they have them in Shenzhen, I think, in Shanghai, and they've got a few of them in some parts of California as well. And but the one I was reading about this week was in China. And just forget whether it's in Shenzhen. It might be in both Shenzhen and Shanghai. And it's a bus service. There's no driver. And in order to make it popular, the government has said that you can drive for free. And apparently it's very popular. Now, I don't know if it's very popular because there's no driver or because it's free. Probably because it's free. But the fellow on the podcast that was reporting about his trip to China said, it's amazing. After a few minutes, everybody's nervous because there's nobody in the driver's seat. And this is in a taxi, not a bus, but in a taxi. And they watch it for a few minutes. They see that the car is doing sensible things, not making any mistakes, and they relax very quickly. He says, I was shocked at how quickly I relaxed and didn't worry about the car making a dumb mistake and getting us into trouble. So now those cars use LiDAR, which is a type of radar, and also cameras. And Tesla decided to go completely 100% cameras only a few years ago because Elon Musk said that they must. And LiDAR is very expensive, and it's also very heavy. So he felt that the camera system was better. But so far as I know, Tesla does not have a driverless service available. So the only ones that I'm aware of in the world they all use the camera plus radar technology. So we have yet to see a fully Tesla-style robotic car where it's just based on cameras only.
Is your Tesla able to drive itself from point A to B?
Yeah, if you have to hold your breath a few times, and you have to be ready to take over at any time. But I've gone on trips, quite long trips, where I have not intervened. Now, there are still some glitches. So I just had an update last week, and I'm pleased to report that the problem with traffic circles appears to have been solved. So there was a problem. You're going around a traffic circle. It's had real trouble sort of grasping that, I guess, and it would waver between the two. If it's a 2-lane traffic circle, it would sometimes not. It wouldn't pick either one. It would sort of straddle the middle, which made me really nervous. If there's a car beside you, it's smart enough to know it's got to move over. But when it's got the whole thing available, but with the new update, it doesn't doing that anymore, and it's not taking the corners. There was a slight problem with sometimes it would cut the corner too sharply, and your back wheel would catch the curb, which is very expensive. So they fixed that, and so that's a really good sign. And the other thing that I noticed, and this is kind of interesting, is I realized that the car was slowing down sometimes at weird times, but there's a lot of construction in Edmonton in the summer, as every summer there is. And I realized after a while it's slowing down because there's a rough road due to construction or something. It's actually seeing the rough road and it's slowing down. So sometimes I think a little bit excessively, but it's slowing down to take care of that. So those problems have been solved. The one problem that still bothers me, and it's easy to override this, but it should be able, is it doesn't always catch the speed limit signs. If it gets the regular speed limit signs perfectly, it notices them all. But if there's a construction zone, for some reason it doesn't catch. And of course, everybody knows in construction zones, speed limit fines double or something. That sign. So I've got to override it, and make sure that it gets down to the construction zone speed rather than not noticing that. And the other thing that's a problem is crossing crosswalks where it says 30 kilometers when lights are flashing. Well, in the Tesla stops. Or it doesn't stop. It slows down to 30 every time it sees that sign, even though the lights are not flashing usually. So I have to manage that a little bit. So it's not 100% ready for release without a driver in the car. There's obviously some problems, but it's getting better every time. The other thing that I read about, not about Tesla, but about these robotic cars in China is, once people realize that there's no driver in the car, they're really rude. They cut in front of the robotic cars, and they do all kinds of strange things because they don't risk getting retaliation from a human being that's upset. So that's one of the things. There's going to be a lot of things like that, actually. People will find out about how people behave when they realize there's no driver in the car.
Yeah, but a real rage against the machine.
Yeah, exactly.
Hilliard, where can people follow you?
So on X, formerly known as Twitter, I'm in the HMACBE, and then we have a weekly note that's free to sign up for, which can be found at MacBeth.McLeodPartners.com, or on Fridays when it comes out, you can just hit the link to the report and then click to sign up for that as well. So those are the two main things that we offer to stay in touch, and also LinkedIn and that sort of stuff. But the main ones are the X and the weekend note.
Hilliard, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Hilliard MacBeth, author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.